Artificial intelligence is suffocating on its own data, and the company claiming to build the breathing tube is either a multi-billion-dollar infrastructure revolution or a masterclass in burning shareholder cash.
Right. So we are parsing through a really heavy stack of tech market outlooks, SEC filings, analyst notes, and financial reports today, all surrounding POET technologies.
Yeah, our goal in this deep dive is to cut through the extreme noise. We need to figure out if their silicon photonics technology is actually the foundational future of AI hardware, or, if their deeply concerning financial realities are just a giant red flag.
Exactly.
For you listening, you are looking at the ultimate high-stakes bet on the physical infrastructure of tomorrow.
Yeah, and to really understand the bet, you have to understand the business first. It essentially boils down to this. POET Technologies designs the plumbing for the AI era.
The plumbing?
Right, the plumbing. So instead of traditional copper wires, they use silicon photonics, meaning they use light to move data between AI chips. Their core proprietary tech is called the Optical Interposer. It's this platform that integrates electronic and photonic devices onto a single chip, just to solve the massive data movement bottleneck that is, frankly, strangling modern data centers.
Okay, so let's unpack that bottleneck really quick, because if you open any tech blog right now or watch any earnings call, everyone is totally fixated on the compute power.
Oh, absolutely.
We obsess over the GPUs, the neural processing units, how smart the models are getting. But the silent crisis, like the physical wall that AI is hitting at 200 miles an hour, is actually the data transfer. It is just the simple act of moving information from point A to point B.
That is the crux of the issue, and it's fundamentally a problem of physics, Look at the last several decades of computing. We've spent billions of dollars optimizing how chips process information.
Right.
But to move that information from chip to chip or server rack to server rack, we still rely heavily on copper cables. And, well, copper has immutable, unbreakable physical limits when it comes to heat, energy consumption, and bandwidth.
Right, because pushing this much data through copper is like trying to push a fire hose amount of water through a standard garden hose.
Yeah.
It's physically impossible without completely blowing the pipes.
That is a perfect way to visualize it. As you crank up the data rate through a copper wire, the copper generates exponential electrical resistance.
And that causes heat.
Exactly.
Yeah.
That resistance is your friction. It creates massive amounts of heat. If you attempt to push the kind of data payload required to train a modern large language model through traditional copper interconnects at hyperscale, the power requirements go completely through the roof.
Wow.
The cooling requirements become physically impossible to manage, so the AI clusters will literally melt down, or they'll just sit there idling, completely starved for data because the pipes are just too slow.
So the compute got incredibly dense and lightning fast, but the communication between the compute nodes is basically stuck in the past.
Precisely. And to understand why, we have to look at how we build chips today. The successive leaps we've made in computing recently were mostly driven by wafer-level integration. Things like 2.5D electrical interposers and hybrid bonding.
Okay, wait, let's unpack that.
Sure.
What does that actually look like? Because you read those terms in these reports and your eyes just glaze over.
It's basically about density. We achieved massive density in compute by building these tightly packed microscopic cities of processors. But the optical layer, the part that handles the high-speed data transmission between those city blocks, has severely lagged behind.
So we have these ultra-dense megacities of compute, but the bridges connecting them are still made of wood.
Yes, exactly. And according to the 2026 Tech Insights Outlook we reviewed, this year is the absolute breaking point. The transition to gate all-around transistors creates an enormous heat and power density problem.
Which forces the change.
Right. Tech Insights points to right now as the inflection point where silicon photonics and co-packaged optics must step in to replace traditional methods.
Okay, so if they've genuinely figured out how to print light-based connections, that completely upends the physical limits of the modern data center. Which, naturally transitions us to the aggressive upside thesis, the bull case.
Yeah, the bull case is huge here.
Why are investors looking at POET Technologies and seeing a potential 10x stock?
It all comes down to their approach to manufacturing. Specifically, something they call the Electrical Optical Interposer, or EOI. POET is bringing standard semiconductor-style manufacturing discipline to optics. They offer active alignment-free manufacturing at the wafer scale.
Meaning what exactly, compared to the old way?
Well, historically, assembling optical hardware has been a nightmare of precision engineering. You had to physically nudge microscopic fibers into alignment with lasers, turn them on, test them, and glue them in place. It's agonizingly slow and labor-bound.
Okay.
But POET uses standard semiconductor lithography. They use light to etch microscopic patterns into silicon, integrating the electronic and photonic devices onto a single chip at the same time. This means cheaper, faster, and much higher volume production.
Okay, that sounds incredible in a vacuum. But, lab science doesn't pay the bills. If this wafer-level integration is so revolutionary, do they have tangible commercial traction?
They do have catalysts that the bulls point to heavily. For instance, they just signed a major joint development agreement with a company called Lumilens.
Right, I saw that in the filings.
Yeah, there is a firm $50 million initial purchase order for these optical engines, and the framework suggests it could scale to over $500 million in cumulative purchases over 5 years.
$500 million is massive. Is it just Lumilens?
No, the ecosystem is expanding. They also announced the joint development of a 1.6T transceiver platform with Lessengers, and they formed a strategic collaboration with Lithium Technology to co-develop next-generation modules.
Wait, hold on. I have to push back here.
Okay.
Because something isn't tracking for me. If this wafer-level integration is so obviously the fix for the biggest physical bottleneck in AI right now, why is PO navigating all these complex joint ventures? And as we'll get to, tying themselves to warrants and future promises. Why not just take this proprietary interposer and sell the underlying tech outright to the massive incumbents? Why not just sell to an NVIDIA or an AMD?
That is the big question. But you have to understand how the semiconductor infrastructure layer actually operates. Securing a ground floor design win is everything. The massive incumbents don't just rip out their existing architecture for a shiny new tech. It takes years of rigorous qualification before a hyperscaler lets your hardware near their billion-dollar clusters. The bull case is entirely about optionality.
So if they become the standard.
Exactly. If POET becomes the foundational underlying architecture for AI interconnects, they scale directly alongside hyperscaler GPU fleet growth. Every new data center would need their engines.
I see. So they become the ultimate toll booth on the AI data highway.
That's the dream scenario, yes.
But to build a toll booth, you have to actually survive long enough to pour the concrete, which forces us to pivot sharply to the bear case. Because looking at these reports, the operational and financial risks are brutal.
They are stark. We have to look at the massive disconnect between their revenue and their valuation. The story is enormous, but look at the cash register. In the first quarter of 2026, POET's product and non-recurring engineering revenue was a minuscule $503,000.
Wait, $500,000?
Yes, $503,000.
For a company promising to revolutionize global AI data centers.
Exactly. And over the trailing 12 months, they reported a net loss of over $81 million.
Oh, wow. So what does that mean for the valuation? Because looking at the market data, we're talking about a market cap floating in the low billions, right? Around the $2.2 billion range.
Yeah, the multiple is astronomical.
Yeah.
But it gets worse when you look at the execution and credibility risks. You have severe class action lawsuits forming around the company right now.
What actually happened there? Because the filings get pretty dense.
Basically, the company was touting imminent product shipments to Celestial AI. But according to the allegations, POET lost every single purchase order and heavily damaged a crucial relationship with Marvell, all because the CFO made public statements that breached confidentiality agreements.
Wait, really? An executive talking out of turn lost them a major contract.
Yes. In the hyperscaler industry, these companies are in an existential R&D arms race. If a supplier leaks they're using a specific PUA-8 interconnect, it tips off competitors to exactly how their next-gen clusters are architected.
So secrecy is a hard requirement. They fumbled the ball because of an unforced executive error.
Precisely. When you're a small-cap company asking paranoid tech giants to trust you with their most critical infrastructure, you cannot have executive leaks destroying contracts. It implies massive operational fragility.
Right. And if they're losing contracts and burning $81 million a year, how are they keeping the lights on? I'm looking at this $400 million registered direct offering. To me, it looks like they're just printing new shares like lottery tickets.
And that leads to the dilution death spiral. The mechanics of that $400 million offering are really where the risk lies. They didn't just sell common shares. Pewitt issued over 19 million shares paired with 19 million warrants at around $21 per unit.
Okay, the warrants always confuse people. Walk me through the mechanics of that for the listener.
Think of a warrant as a guaranteed coupon that lets an institution buy more stock later at a set price. These 19 million warrants have an exercise price of $26.15 over the next 3 years.
So if the stock naturally rallies to, say, $35,
The institutions exercise the warrants. They buy 19 million brand new shares directly from Pewitt for only $26.15 and immediately sell them for $35 to lock in the profit, which instantly floods the market with 19 million new shares.
it's a massive trapdoor. It just artificially caps the stock price and dilutes everyone else.
Yes. And remember the Lumilens deal, that $50 million validation.
Yeah.
To secure that, Pewitt granted Lumilens warrants to purchase up to nearly 23 million shares over 9 years at an $8.25 exercise price.
You're kidding. So the partner gets to buy in at a massive discount, too.
Exactly. These capital-intensive ramp cycles are crushing the per-share upside. If you invest today, you are essentially paying for their manufacturing scale-up out of your own equity.
Wow. Okay, let's ground this in the exact present-day market reality. The market cap is in the low billions. The stock has seen massive volatility, right? Up over 200% over the trailing 52 weeks, but subject to violent pullbacks.
Yeah, it's largely driven by narrative spikes, not fundamental earnings. They are deeply unprofitable. They burn over $4.5 million in Q1 just on R&D alone.
And right in the middle of this, they decide to re-domicile from Canada to the U.S. to avoid PFIC tax status.
I have to ask, is moving to the U.S. a genuine step toward maturity or just a distraction from the fact they only made $500,000 last quarter?
It's a bit of both. The PFIC cleanup is objectively good corporate governance for U.S. investors. But you're right, it doesn't solve the core issue. It doesn't fix their pre-scale economics or high operational fragility. Okay, so let's summarize the investor sentiment split here.
Yeah.
What exactly do the bulls believe?
Bulls believe the current price is a cheap entry ticket to the foundational hardware of the 2027 AI deployments. They see the $400 million raise as necessary ammunition to scale manufacturing in Malaysia and secure acquisitions. To them, Lumilens and Lytton are proof of concept.
And what do the bears believe?
Bears believe Pewitt is just a story stock writing AI photonics hype. They see a company burning cash, botching major contracts through executive errors, and surviving by constantly diluting the retail shareholders who buy into the press releases.
Right, that brings us to the final verdict. You've looked at the physics, the balance sheet, the lawsuits, and the warrant ceilings. I need a final, definitive verdict from you. No hedging, buy, hold, or sell.
The verdict is sell.
Direct. Give me the 3 specific reasons why.
First, extreme valuation disconnect. A market cap in the low billions cannot be fundamentally justified by sub-$1 million quarterly revenues in a highly competitive, capital-intensive hardware sector.
Right. Reason 2.
Crushing dilution risk. The recent $400 million financing and the millions of attached warrants fundamentally cap the upside for current shareholders. You are forced to pay for their manufacturing scale-up out of your own equity.
And the 3rd reason?
Demonstrated execution failure. The loss of major contracts due to executive confidentiality breaches and the subsequent class action lawsuits indicate a severe lack of the commercial operational discipline required to actually compete with large semiconductor incumbents.
Being early to a multi-billion-dollar technological revolution is exactly the same as being wrong right, up until the money actually hits the bank.